The committee will come to order. This hearing is entitled Emerging Threats to Stability, Considering the Systemic Risk of Leveraged Lending. I now recognize myself for 4 minutes to give an opening statement.
This is a hearing in the House Financial Services Committee from earlier this month, in June 2019, to examine the potential risks posed by leveraged lending, loans made to companies that already have a large debt load. And many lawmakers say that they're concerned that leveraged loans, many of which are originated by banks, could exacerbate a future economic downturn. This is Representative Gregory Meeks, a Democrat from Missouri and chairman of the Subcommittee for Consumer Protection and Financial Institutions.
I've been very concerned about the rapid rise of leveraged loans and covenant-light loans in recent years. The Fed, the IMF, and many others have referred to these loans as recession amplifiers, and I believe we must consider the possibility that they may prove systemic. When the federal crises hit...
But there is a diversity of opinion in Congress about whether leveraged loans pose the kind of threat that Meeks and others claim. This is Representative Andy Barr, a Republican from Kentucky, offering a counterpoint that not only is leveraged lending not a risk to the economy, but the regulatory scrutiny of leveraged loans has the potential to make it harder for companies to get financing, which can create the kind of economic slowdown that everyone wants to avoid.
I don't get it. These are high-performing. They are liquidity providers in a downturn. They represent locked up the long-term non-mark-to-market investors. And why does this matter? Because 72% of all American companies are non-investment grade. Leveraged loans provide $1.7 trillion in financing to American companies, and most of the commercial credit in the market comes from non-banks. Because Dodd-Frank era regulation is limiting the amount of leveraged loans a bank can take on, the capacity of non-banks to fill the liquidity gap becomes that much more important. If non-bank lenders become constrained, then guess what? Funding costs will go up. Funding costs go up, bankruptcies happen. Bankruptcies happened, there are less jobs, there are lower wages. That is not good for financial stability.
So maybe it's worth backing up for a minute. What is leverage lending, and does it pose a threat to the financial system? From American Banker, I'm John Heltman, and this is Bank Shot, a podcast about banks, finance, and the world we live in. The first step to understanding whether leverage lending poses a risk to the financial system is to detail what exactly is meant by a leveraged loan. And to answer that question, I asked Meredith Coffey.
My name is Meredith Coffey. I run research and co-head public policy at the LSTA. The LSTA is a trade association for the U.S. syndicated loan market. That's about a $4.4 trillion market. When you think about leveraged loans, it's companies, frankly, the majority of companies in America. It's companies like American Airlines, Hilton, Dell Computers. I mean, the vast majority of companies in the U.S. are, in fact, non-investment grade or leveraged.
The term leveraged loan is a sort of catch-all term for a loan made to a company whose credit is below investment grade, which means that rating agencies have determined that there is a risk that the company will not be able to pay the loan back. And that reason tends to be that the companies already have a sizable debt load.
Clearly, the higher rated you are, so if you're rated AAA, single A, double A, or triple B, you're investment grade. And what that means is you typically have very low leverage, and it's a handful of sort of the bluest blue chip companies in America. So like Apple would be an investment grade company, IBM would be an investment grade company. All the rest of the companies in the US are non-investment grade or leveraged. So again, they're very common names that you would know. As I mentioned before, American Airlines, Hilton, Dell, et cetera. Most of the companies that you know actually are not investment grade.
So when a company that is not investment grade decides that it wants to take on more debt, they have to seek out a leveraged loan. And there are a couple flavors to choose from.
So if we look at the leveraged loan market, we should probably break it into two categories. The first category is what's called an institutional term loan. So this is a term loan where a loan is borrowed and then repaid over time, usually 5 to 7 years is a typical term. So that's the first part of the market, and that's about $1.2 trillion of outstanding loans. The second part of the leveraged loan market are leveraged revolving bank loans. So these are loans that are held by banks, and they're called revolvers or revolving loans in that you can draw them down, repay them, draw them down again, much like a credit card. And that's about $500 to $700 billion.
To get these kinds of loans, companies will often turn to banks, but banks don't just shell out the whole loan themselves. They syndicate it. So to borrow Meredith's example, if Dell Computers wants a $100 million loan to make better computers, they will go to a bank with a proposal and if the bank agrees to sponsor the loan, they will shop that debt around to other banks. And if, say, 20 banks agree to take on a $5 million piece of that loan, then the loan is syndicated. But the banks also don't typically hold on to that loan themselves. They sell it to other investors, including funds known as collateralized loan obligations.
So a CLO works a lot like a mutual fund, whereby you've got an active manager, an active loan manager, who basically goes out and picks a series of different loans from different institutions based on sort of all the risk return characteristics that we were just talking about, builds a portfolio and funds that through a securitization mechanism. But it's very much an active management structure. It's kind of analogous to a mutual fund, but just that the funding comes from strips of debt and equity as opposed to all equity.
Whereas a mutual fund is a basket of stocks, a CLO is a basket of different slices of these syndicated loans to all kinds of companies doing all kinds of business, and with all kinds of risk and all kinds of promised returns. And those CLOs are held by all kinds of financial firms, asset managers, insurance companies, institutional investors, and pension funds, to name a few. And the reason they want this debt is because the returns are attractive.
So if you're looking at a loan investor is typically earning LIBOR, that's the base rate, plus a spread over LIBOR. And that spread over LIBOR typically is between about 300 and 400 basis points. So if LIBOR is 2.5% and you're earning, let's say, 3.5% as a margin, you're earning about 6% total return. I think year-to-date returns in the loan market are about 5.5% right now. And by the way, and so compare that to other investments. For instance, if you invest in treasuries right now, that's a 2% yield.
And the default rates on leveraged loans are fairly small. Not many companies fail to meet these debt obligations, meaning investors tend to get the promised returns even if the debt comes with risk.
Generally, they perform quite well. So if we look at the historical default rate, it's around 3%, which means 97% don't default. If we look at the default rate right now, I think it's about 1.3% for the last year. It's expected to be around 1.5% for the next few years, so the default rate is extremely low.
What this means is that more and more investors want to get in on these returns, and so the market for leveraged loans has grown substantially over the last decade.
And it has grown substantially in the past 10 to 12 years. So if we look at 2008, there's about $600 billion of institutional loans outstanding. Fast forward 11 years, it's about $1.2 trillion. So it has grown a lot.
And that's where things get complicated. Could you introduce yourself, please?
Sure. So Lisa Kwasnowski, I work at DBRS. So DBRS is a rating agency founded in Canada. We're actually the largest rating agency in Canada. More recently, DBRS expanded outside of Canada in the early 2000s into the U.S. as well as in Europe. I'm responsible for covering some large banks globally and also non-banks. So kind of helps me with the leverage lending focus because the leverage loans are being originated out of both.
She said that banks are central to originating leveraged loans, but because their balance sheets aren't the final destination, and there is a lot of demand for this high-yielding product, intermediaries are finding ways to connect supply with demand.
The demand is so much greater than the supply. They'll send that off to anybody who's interested in earning a higher yielding product, right? So fixed income funds, pension funds, insurance companies. Well, insurance companies will only buy investment grade debt. So basically it would go into a CLO, and then the CLO would be repackaged, potentially investment grade, and then an insurance company could buy it. So it goes into various forms, but it typically kind of goes into funds that are sort of like, well, they're institutional investors, but a lot of times they're managing money for kind of Main Street.
The banks may not hold this debt for the most part, but they do hold some risk. Until the loans get syndicated, they are underwriting them, often for 6 or 12 months, and if something goes wrong in that time frame, they're holding the bag. And that would probably be okay, she said, because banks are well capitalized and could withstand the losses. And they are that way because there are bank regulators who make sure that they wouldn't underwrite so many of these loans that they would be at a risk of going under if the economy slumped. But the same can't be said for the institutional investors who buy these products. And because single loans can be held by lots of different companies with different or no regulators, it isn't clear who would be in charge if a lot of these loans turned sour all at the same time.
the loans go off into other vehicles. And I think there is some concern about the other vehicles, and it's not very transparent. So we don't necessarily have information on who's buying the loans or which pieces, and do they have the whole loan? No, they actually only have a piece of it. So if the loan kind of doesn't perform well, then who's the person to step in and say, here's how we're going to try to fix this problem and work out the loan or service it? There's not really a person to do that. So I think it's a little bit of an unknown world where we haven't seen what would happen.
And again, the volume of these loans and the value of these loans is growing quickly in ways that are reminiscent of mortgage-backed securities prior to 2008.
So leverage loans today are at 1.2 trillion. That's up from about 500 billion pre-crisis. So it's up quite substantially. It's at record levels. When we were looking at originations last year, leverage loan originations, which means like the new loans, were about the same level as mortgage originations. So I don't know if that kind of puts it in perspective, but it's pretty big. I mean, it's not like this is a small piece of the pie.
So in terms of value, there's as much value in every mortgage that's being made in the country last year as there is in all the leveraged loans being made in the country last year.
Right, correct. Yep.
A lot of this debt is using this originate to distribute model that is somewhat reminiscent of mortgage-backed securities before the crisis.
That's Marcus Stanley.
My name is Marcus Stanley. I'm the policy director of Americans for Financial Reform, and we are a public interest coalition that was put together in the wake of the financial crisis to work for a stronger and more effective regulation of the financial sector.
And he says the heat of this market, the demand for these leveraged loans, is the kind of precondition that leads to more and more loans being made, often with lower underwriting standards and more risk.
This kind of originate to distribute model where someone makes a loan and then doesn't hold it on their books but sells it on to someone else was, people believe, quite related to the problems of the financial crisis. And to see it again in another sort of subprime lending sector has led to concerns. I mean, there are certainly a lot of differences between mortgage debt and subprime mortgage debt and leverage lending. The borrowers are quite different. In one case, you have businesses borrowing. In the other case, it's households for a household need mortgages. But some things in the market structure and the growth are sort of disturbingly reminiscent.
Besides the similarity of one firm originating loans that would ultimately be held by someone else, he said that CLOs, these baskets of leveraged loans, are coming to be thought of and treated somewhat like securities, which are meant to diffuse risk, but that can also hide riskier assets among well-performing ones.
The magic of securitization, and also sort of the danger, which is related to the danger of it, is that it allows you to take bad quality loans and make a set of securities, some of which are very high grade, sort of investment grade, because those senior ones, which are the last to take the loss, might get a very high investment grade rating, even though the underlying collateral is subprime, is very risky debt. So you have these structures are actually fairly complicated in terms of who takes what loss when, and there are various assumptions that ratings agencies make in determining what's investment grade and what isn't. In the case of the ratings agencies are really key players here, because they're the ones who decide whether something qualifies as investment grade. And in the 2008 financial crisis, we saw those assumptions break down. So we had these securitizations based on subprime mortgages. There were the senior tranches were assumed to be investment grade, even though they were based on subprime. And it turned out they were much, much riskier than they were sold as. These are the toxic assets that were related to the crisis. And when people realized they were much riskier, that whole market kind of shut down.
But as he said, there are some important differences between leveraged lending and mortgage-backed securities. namely that companies shouldering these debt loads are not analogous to people taking out adjustable rate mortgages where they may not understand the terms or the conditions of the loan. And Meredith Coffey said that because the borrowers are companies who have a keen interest in staying afloat, the risks of broad default in these loans in the event of a market downturn are somewhat different than in the mortgage crisis. And the holders of the debt, for the most part, won't face the pressure of everyone trying to get out their investments at the same time.
We've done a fair amount of research on the holders of leveraged loans, and we do not see a contagion effect there. The holders of leveraged loans tend to be very stable holders. They don't have mark-to-market pressure. They generally do not have, fire sale pressures. There's a very small segment of the market that has redemption risk. So something that would force sort of a domino or a leveraged unwind doesn't really exist in the loan space, in the leveraged loan space. Second, while there's a lot of talk about companies that are loans that are being issued today having high leverage, if we actually look at companies that are outstanding, companies that have been around for a while, they've actually been deleveraging.
But on the other hand, the leveraged loan market is undeniably creating more debt. And debt, corporate or otherwise, creates risk when the economic picture becomes less certain.
Even if this doesn't replicate 2008, even if this doesn't cause the banking and financial sector to freeze up or multiple major banks to fail, there's still the issue of what happens to the indebted businesses. I mean, the businesses, the non-financial businesses taking out these loans have incurred a heavy debt load. That's basically what leverage lending is, when you take out a lot more debt on top of already being pretty indebted. And that requires a lot of cash flow to service that debt. And that really means two things. One is that your cash flow is not going to investment for the future or improving your business. It's going to servicing this debt. And the second is, if there's any interruption in your business, if there's an economic downturn, if there's a problem in your sector, then you are going to face a risk of bankruptcy much earlier because you have such a high debt load. And if you can't renegotiate that debt, then even if you're making, even if you've got a positive cash flow, you may be driven out of business because you can't do the debt service.
So another question to ask is, where are the regulators on all of this? And in the interest of being thematically consistent, the answer is complicated. The Fed, OCC, and FDIC in 2013 issued a guidance to banks laying out their expectations for underwriting of leveraged loans. And if you want to hear the backstory about that guidance, last week's episode talked about it at considerable length. Jerome Powell, the chairman of the Federal Reserve, said last week that both the Financial Stability Board, an international body of federal regulators based in Basel, Switzerland, and the U.S. Financial Stability Oversight Council have been watching this matter closely.
I feel like that's in a good place, but we never say mission accomplished on that. We will keep monitoring that carefully. What's happened though is the paper is now owned by market-based vehicles, collateralized loan obligations, mutual funds, and things like that. And so we now have we have a good sense of domestically of where that paper is. I think internationally, not as much, and the Financial Stability Board is actually looking more carefully at that, and we monitor those vehicles to see what they are, and they're actually pretty stably funded in the sense that there's no run risk, but there's still macroeconomic risk, and this is something that we take very seriously, and that the FSOC, the Financial Stability Oversight Council, is looking at, and we call it out as a macroeconomic risk, but it's not really a financial stability risk in the sense that it could undermine the ability of the financial system to do its job of intermediating credit.
But he also said that the Fed and other regulators are doing their part to make sure that banks don't go too far in originating loans that don't make sense for borrowers to repay in the first place.
I think the issue isn't that the banks don't understand what the rules are. The issue is that the risk isn't in the banks. It's out in those market-based vehicles. So I'm not saying it's perfect, but I think we do understand what risks the banks are running. And really the question is, how concerned should we be about large holdings by market-based vehicles that I mentioned, and what risks do they present? And we're very carefully assessing that.
But the challenge to regulators in this case is that leveraged lending falls across jurisdictional boundaries between banks, private equity, institutional investors, and everywhere in between. and it's hard to get all those regulating bodies to pull in the same direction unless there's a glaring problem. And by then, it can often be too late.
I think it's harder to happen without sort of a impetus. I just think when there's sort of like a problem is when people work quickly to solve it, and that would be my thought as to what could happen. But I guess anything can happen if regulators seem to think this shadow banking sector is growing too large. I would assume that they could have the ability to say any institution extending credit in a bank-like capacity has to be regulated. But I would imagine that would be harder to do.
Bankshot is written, produced, and edited by me, John Helpman. Executive producer is Rob Blackwell. Our website is designed by Min Choi. Special thanks to the Loan Syndications and Trading Association, Americans for Financial Reform, and DBRS. If you liked what you heard, be sure to subscribe and leave us a rating on iTunes. And if you're feeling extra generous, you can go ahead and leave us a review as well. And you'll have an extra week to do that because we're taking a break for Independence Day, but we'll be back in rotation on July 11th. If you're not already a subscriber, check it out. Bankshot listeners can gain access to the news, insight, and analysis that you can't get anywhere else at a steep discount. Visit www.americanbanker.com for details. I'm John Helpman, and thanks for listening.